Welcome back to the Indicator Library. Today we're covering one of the most widely used and widely misunderstood tools in technical analysis: Fibonacci. Most traders draw a few horizontal lines, but very few understand what those levels actually represent. Fibonacci does not predict price. It measures potential retracement zones within a trend. In this video, we'll break down what Fibonacci retracements actually represent, where the key ratios come from, how to draw Fibonacci properly, which levels matter most, how traders use it in trending markets, where it fails, and how to combine it with confirmation tools. Let's begin. Fibonacci retracement is a tool used to measure pullbacks within a trend. It does not identify direction. It assumes a trend already exists, and it measures how far price pulls back before potentially continuing. Fibonacci is about structure, not prediction. The Fibonacci sequence is a mathematical progression where each number is the sum of the two before it: 0, 1, 1, 2, 3, 5, 8, 13. As the sequence grows, ratios between numbers approach specific constants. The most important ratio is 0.618. Often called the golden ratio. Other commonly used levels include 0.382, 0.5, 0.786. These levels are not magic. They represent areas where pullbacks often slow or react. On TradingView, Fibonacci is measured from 0 to 1. 0 is the start of the move. 1 is the end of the move. In an uptrend, draw from the swing low to the swing high. That places 1 at the low and 0 at the high. In a downtrend, draw from the swing high to the swing low. That places 1 at the high and 0 at the low. The anchor points matter. Always measure clean structure, not random swings. The 0.382 level is considered a shallow pullback. Strong trends often respect this level. The 0.5 level is psychological. It's not technically a Fibonacci ratio, but it's widely watched. The 0.618 level is the most significant. This is known as the golden ratio. But experienced traders often focus on a zone, not a single line. The area between 0.618 and 0.786 is commonly called the golden pocket. This is a deep retracement zone where strong trends frequently resume. The 0.786 level represents the lower boundary of that pocket. If price breaks decisively beyond 0.786, trend continuation becomes less likely. Traders do not blindly buy every level. They wait for confirmation. For example, if price pulls back to 0.618 and prints a bullish rejection candle, that reaction matters. Fibonacci defines the zone. Price action confirms the entry. It's a framework, not a trigger. Common mistakes with Fibonacci include drawing Fibonacci in sideways markets, anchoring to minor swings, ignoring higher timeframes, stacking too many levels, and assuming price must react. Fibonacci shows probability zones, not guarantees. Fibonacci works best in trending markets, after expansion, followed by controlled pullbacks. It performs poorly inside tight consolidation. Trend first, then measure retracement. Fibonacci becomes powerful when combined with confirmation tools. Trend bias from moving averages. Momentum from RSI or MACD. Volume expansion on reaction. Structure alignment across timeframes. When multiple factors align at a Fibonacci level, probability improves. On lower timeframes, noise increases. On higher timeframes, signals are slower but stronger. Adjust based on structure, not emotion. Fibonacci is not for blind entries. Stops should sit beyond structural invalidation, not directly on the line. Targets can be set using prior highs and lows, or Fibonacci extensions. Always define risk before defining reward. Hi, I'm Indy. So let's summarize. So what is Fibonacci really? It's not a prediction tool. It's not a reversal guarantee. It's a retracement measurement tool. It defines potential pullback zones within an existing trend. Used correctly, it improves structure awareness. Used blindly, it creates confusion. The lesson is simple. Trade structure. Measure pullbacks. Wait for confirmation. If this helped clarify things for you, make sure you like and subscribe, and explore the rest of the indicator library. We're building real understanding here, step by step, and I'll see you in the next one.